Is it possible to generate $150,000 of income during retirement and pay less than 2% in tax? Well, today we're going to be talking about a family that met with us recently, and they were trying to figure out the way for them to generate the most amount of income possible, which was for them about $150,000, and pay the least amount of tax possible. My name is Sebastian Guerra, president and partner here at Guerra Wealth Advisors, where we help families get to the point where work becomes an option and not an obligation. So if you're an individual that's planning on retiring over the next couple of years, or maybe you're already retired and you're looking for strategies on how to pay less money in taxes, how to optimize your investments, how to make sure that you have a solid estate plan for your family for when you're not here, don't forget to subscribe. I put out videos every single week on these subjects, and I believe that it's so important that if we're entering the stage of retirement, we're as knowledgeable as possible as it pertains to these subjects. So let's talk about the family. So we recently met with Mark and Lisa Johnson. They're both about 62 years old, and they just recently retired. They live in the state of Florida. So if you don't know, state of Florida has no state income tax, and their retirement goals that they wanted to generate about $150,000 a year of income in their pocket and pay the least amount of tax possible. Now, the beautiful thing is that they were going to be getting about $50,000 a year of Social Security between the two of them, which means that they have about $100,000 in income that they're going to need to withdraw from their investments. And their total investments right now was about $1.7 million between all retirement accounts, investment accounts, bank accounts, and brokerage accounts. So now the question is, where do they withdraw the money from and pay the least amount of tax possible? So if you're an individual that's planning on retiring over the next couple of years, or maybe you're already retired and you're looking for strategies on how to pay the least amount of tax possible, you can click on the link below and you can book a free session with one of our wealth advisors. They'll map out a detailed plan on exactly how much you should be withdrawing from all of your accounts as you're entering the stage of retirement. So the first thing that we want to look at is what's the current investment mix of those $1,750,000? Well, they have a Roth IRA with about $400,000 in there. They have a brokerage account right now that has about $500,000 in there. They have a traditional IRA with about $750,000, and they have a little bit of money in 401k, and then they have some money sitting in the bank, which is about $100,000. That's the total of the $1,750,000. So now the question is, well, we know that they have a $50,000 coming in from Social Security, and now they need another $100,000 from these accounts that we just went over. But what's the most optimal approach on where they should be withdrawing the money from on a yearly basis to pay the least amount of tax possible? So as we already covered, they have about $50,000 a year that they're getting from their Social Security check. Now, remember, we spoke about this in previous videos where we talked about how Social Security actually gets taxed. You see, Social Security is not always taxed. 50% of it can be taxed, or maybe 85% of it can be taxed. Now, it all depends on something called provisional income. So we went over that in another video, but in their specific case, they were going to have to pay taxes on about $15,000 of the amount that they were going to be getting from Social Security. Now, as it pertains to Roth IRAs, we said that they have a Roth IRA, and what we estimated is that they were going to be withdrawing about $30,000 a year from their Roth IRA. As you've seen from previous videos, Roth IRA withdrawals are completely tax-free. Now, as it pertains to their brokerage account, we decided that they were going to be withdrawing about $30,000 a year on a yearly basis from that brokerage account as well. Now, why is that? You see, a lot of people don't know that if you withdraw money from brokerage accounts, there's this beautiful thing called capital gains. But these capital gains, if you make less than about $94,000 a year as a married couple, you can technically avoid entirely paying taxes on that withdrawal from your brokerage account. So what we did is we strategized exactly how much should be withdrawn from that brokerage account so that it keeps them under that $94,000 of taxable income. And by doing so, we were able to get $30,000 out of their brokerage account and paid 0% in tax because it was under the $94,000 for that year. So the fourth thing that we did is we created a strategy for them to be receiving dividends and interest from their brokerage accounts. Now, if you don't know this already, if you right now are an individual that is in the 12% tax bracket, any dividends, any qualified dividends that you receive, you don't have to pay taxes on any of those qualified dividends if you're still in the 12% tax bracket. So what we did is we strategized to make sure that their dividends and interest was going to be about $15,000, and the majority of this money was going to be coming from qualified dividends as well as municipal bonds. So when you added up these withdrawals, which added up to about $15,000, Well, the beautiful thing is because they're under that 12% tax bracket, then that income is not going to be taxed either. So the last and final thing that we did is we now created a strategy to withdraw the remaining $25,000 that they needed from an environment that would pay the least amount of tax possible. So what we did is we pulled it out of an IRA. Now, you might be thinking, well, aren't IRAs normally taxed? Well, the beautiful thing is that if you have something called a standard deduction, which if you're married, it's about $30,000. And if you're married above the age of 65 years old, it can be as high as $33,000. So in their case, we just withdrew $25,000 out of their IRA because they were still going to stay in the 10 to 12% tax bracket. Then that money was going to be completely wiped out due to the standard deduction. So now we just went over a bunch of different strategies and how to withdraw money and from what types of accounts, but now let's put it all together so that we can really see what the total tax impact as you're withdrawing money from all of these locations. So as you add it all up, here is the way it would work. So they would be generating about $50,000 a year from Social Security, and because we said earlier that part of it was going to be taxed, there was going to be about $1,000 that was going to have to be taxed, and that was going to be money they were going to have to pay Uncle Sam. Now, as we spoke about earlier, Roth IRA withdrawals, $30,000 was going to be the withdrawal, zero tax because it's a Roth IRA. Long-term capital gains, $30,000 was going to come out, and because they're under that 12% bracket, then 0% of it gets taxed as it pertains to capital gains. As it pertains to qualified interest and municipal bonds, $15,000 was going to be coming from there, 0% or $0 was going to have to be taxed. And as it pertains to the IRA, $25,000 was going to be coming out, but because of the standard deduction, that was going to help wipe out the majority of the tax, which means there was still about $1,500 that were going to be paid. So now when you add up the $1,000 plus the $1,500, that gives us a grand total of $2,500. Now, $2,500, when the person is generating $150,000 a year from withdrawals, that puts them in an effective rate of about 1.6%. That's less than 2% in tax, but it's all because they created a withdrawal strategy on knowing exactly where they're going to be withdrawing from on a yearly basis from the right locations so that their money is lasting them longer and they're paying the least amount of tax possible during retirement. So if you have any friends or family that has retirement accounts or investment accounts and they're planning on retiring over the next couple of years, make sure that you grab this video and you share it with them. I can't tell you the amount of people that wish they would have learned this information before they retired. So make sure that you're helping your friends and your family so that they can be on their way to a better retirement.